Well, let's kick things off. So today we're going beyond rents. Even though our business Spark Rental is about rental income, we're really more about creating passive income through real estate um, to help you eventually replace your full-time income. So, I mean, that's really what this is about. It doesn't have to just be about rents or rental income. We are not all about normal or average or boring or any of that stuff here. We're not about median net worths or average investment portfolios, about building passive income, replace your 9 to 5 salary, which in turn makes you able to quit your job or retire in your 30s, your 40s, your 50s, or not, or you can go save the world, doing work that you are passionate about. It's not normal, it's not ordinary, financial independence / retiring early, which we refer to as FIRE. It means extraordinary lengths, going to extraordinary lengths to see extraordinary results. So, maybe you like your job, but don't want to rely on it full time to pay your bills. Maybe you're ready to fire your boss and go, pour wines at a winery or write novels. I would like to do both of those things. Maybe you just want to spend more time with your family and friends. So real estate investing plays a big role, at least for Deni and myself, in how we are getting there. It's not the only way that we invest, and we'll talk about that a little bit more in this. But again, this is an interactive webinar. So in the chat, let us know when you would like to reach financial independence. Whether that's the traditional age of your 60s, or whether you want to reach it in your 30s or 40s. Let us know. Yeah, we're giving out participation awards here, right?
And it's often said accountability. So when you put it in the chat, when you write things down, you have a more of a chance of attaining it.
You put it out to the universe and it comes back to you.
Right.
So this is not your typical webinar. We're not going to deliver any sales pitches today. This is really just an informational webinar. We wanted to just get you guys together. It's been a while since we've done since we put together a webinar of our own for you guys. So we wanted to welcome you guys back with a webinar with no sales pitch, nothing to buy or sell or anything. We're just going to go over some ideas, present a little bit of data, a little bit of information. So Deni, give us a quick overview of what we're going to be talking about today, a little table of contents.
Well, I think many people think investing is simply buying a rental property, renting it out, and you're done. And there are many other ways of investing. And we look around us, we see what's going on with the various, between the eviction moratorium and some of the house prices right now. So it definitely makes you want to look at other ways to invest.
Yeah, so we're gonna cover why you should bother diversifying at all. We actually hear that question more than you might think. We're gonna talk about why you should bother investing in real estate at all, and the role of stocks in your FIRE portfolio. Also, the meat of the webinar will be 9 ways to diversify your real estate investments to create a whole bunch of different streams of real estate income. And then we'll wrap up with some next steps, your homework assignments here to really take action and kick off. So, obligatory credential slide. We've been around this block for a long time. Between the two of us, we have 60 years combined experience in real estate, maybe 55, maybe not quite 60, but we've both spent our entire careers in and around real estate, and real estate investing in particular. So
just for a quick second, I just want to put I love Christina Cullen. She's 3 years, dude. She wants to get there in 3 years. Michael could probably stop working now, which is awesome. Matthew wants it at age 40, and Christina says she will fire at 50, and she's 47, so she's looking at 3 years. So
awesome.
That's awesome. Sorry.
3 years is actually about my remaining timeline as well. I mean, I don't consider myself financially independent yet, even though I kind of live what I consider like a fiery lifestyle. But yeah, I got serious about this maybe 3 years ago, hoping to reach financial independence within the next 3 years. So you can do it very quickly if you're super serious about it and you have a really high savings rate. So, but everyone has their own goals with FIRE. I mean, Deni wants to spend more time with her family, has a more traditional lifestyle in the US. I mean, I love to travel, so for me, a lot of it is about just being able to live anywhere and travel anytime and spend as much time with my daughter and my family as I want. And that actually is me in that cage. This is not a stock photo. That is a great white shark that's in South Africa. So, Deni, how is this webinar different from your typical webinar?
Well, we certainly aren't going to do this. We're not going to do that. And if we did, I would be lost, a while. Yeah, this is definitely interactive. We encourage it. So please participate. As you see, we've been, going back and forth in chat. We're not doing the whole kindergarten, I'm going to read you a story class here. So, yeah.
Yeah. So, start firing questions in the chat. We have several pause points throughout the webinar where we will be addressing those questions. And at the end, we'll do a traditional 10-minute Q&A as well. Please turn off your Skype, your phone, your email notifications, because we are going to move through this really fast.
Right.
So on that note, let's talk about why you should bother diversifying at all. The short answer is to reduce risk. Your mother always told you, don't put all your eggs in one basket, right? Because if that one basket drops, then you lose all your eggs. So if the stock market crashes and your entire investment portfolio is in stocks, you're in trouble, right? To take a really extreme example, imagine that all of your life savings was invested in Enron circa 2003 or whenever they went belly up. You'd really be in trouble.
And there were people that were just in retirement or on the brink of retirement that really got hurt.
Right. So the idea behind diversification is that one asset might collapse, but you have a bunch of other assets that don't collapse. And what you want is assets with low correlations to one another, so that just because one crashes doesn't mean that all the others go with it. And we'll go through a quick example here. So these are median home prices in the US since the early 60s. And the gray lines are, of course, recessions. And you can see that there's really only one recession where they really collapse, and that was, of course, the Great Recession, which was largely caused by a housing bubble bursting. That's unusual. In most of these recessions, you really just see home prices kind of flatlining a little bit rather than plummeting the way that they did in 2008. So there's some stability here. There's much less volatility. So here's stocks in recessions, and you can see the stocks just utterly collapsing during recessions, during most of these recessions, or really all of these recessions. So real estate does provide a nice buffer. Here's another chart showing how home prices performed in various recessions over the last 30 years or so. And in most of them, they did just fine. And again, the one notable example here is really the 2008 Great Recession. And that was a notable exception because it was largely caused by real estate, which is unusual. So real estate really does provide you with true diversification from stocks. Now, real estate and stocks serve different roles in your portfolio. Just because Deni and I are real estate people doesn't mean that we don't own any stocks. We certainly do, because they complement one another in your investment portfolio. So stocks are really growth oriented. Most of the returns historically from stocks come from price appreciation rather than income yield, which comes from dividends. Some stocks pay dividends, not all stocks. So stocks are more growth oriented, less income oriented. Stocks are highly liquid. You can buy and sell them instantly, which you certainly cannot with real estate. And we'll talk about that in a minute. With stocks, it's easy to diversify, at least within the asset class of stocks. You can go out and buy stocks from all over the world with the click of a mouse. You can buy large cap stocks, mid cap stocks, small cap stocks. You can buy stocks in various sectors of the economy, right? All across the economy, in every part of the world, at every capitalization level. So it's very easy to diversify within your stock portfolio. They don't cost much cash. It doesn't require much cash to go out and invest in stocks. If you have $100, you can go out and start buying shares in ETFs that just mimic index funds, right? It's also easy to invest in stocks through tax-sheltered accounts, like your retirement accounts, or even HSAs, or ESAs, education savings accounts, or 529 plans for your kids' college. So it's really easy to invest in stocks in these tax-sheltered accounts, and it's really easy to automate your investments, your stock investments, through a robo-advisor. None of that is really true with real estate, and we'll talk about that in a second. So, by the way, if you're not familiar with robo-advisors, I recommend them for your stock investments if you're not, an avid stock investor already. If you don't know a lot about stocks, just delegate it to a robo-advisor. Here are a couple free ones. I personally use Charles Schwab. It's free if you invest with at least $5,000. If you don't have $5,000 to invest in stocks, try SoFi Invest. A couple others you can try are Ally Invest and M1 Finance. These are all free robo-advisors. So, there's very little barrier to entry here, and they can manage your stock investments for you. They can automate them for you. You don't have to worry about it. You don't have to track the stock market's motions. So it just makes it really easy.
Many of them offer a lot of good information just in how to embark on all of this. So you're also learning while you're going through it.
Yeah, and with your stock investments don't have to take up much of your time because you can automate them. So, they can take as little as a couple minutes a month. Just set up recurring transfers to your robo-advisor account, and it'll take care of the rest. Now,
and there are links in the chat for those too.
Okay, yeah. So we put some links to those robo-advisors we just mentioned if you're interested in the chat. So that's the role of stocks in your portfolio, in your investment portfolio. Now, real estate plays a very different role in your investment portfolio. It tends to be more income oriented than stocks. A much greater proportion of the historical returns from real estate come from income yield as opposed to appreciation. Real estate is also a hedge against inflation because it's a real asset. It has inherent value. People always need housing, and they're going to pay whatever the going rate in that currency, whatever that currency happens to be worth. They'll pay that because it has inherent value. Unlike, say, bonds, where you get eaten alive with inflation if inflation really takes off. Real estate comes with some inherent tax advantages. So there are some enormous deductions that you get. You can really deduct any conceivable expense that you have related to your investment properties. And by the way, those deductible expenses, those are above the line deductions. So they do not impact whether you take the standard deduction or whether you itemize your personal deductions. So you can still deduct your real estate investment expenses and take the standard deduction if you want. And then there are tax advantages like depreciation, where you can actually deduct the cost of the building over time, over 27 and a half years. There are many ways to defer or even avoid entirely capital gains taxes. You don't need any special tax sheltered accounts to get these tax advantages with real estate, unlike with stocks. Real estate has poor liquidity. You cannot go out and buy it instantly with the click of a mouse, at least not direct real estate ownership. It takes months to buy or sell real estate in most cases. It takes a lot of cash to invest in real estate in most cases. So that makes it harder to diversify when each investment is going to require tens of thousands of dollars at minimum in a down payment. So it's harder to diversify within your real estate investment portfolio. So what does a balanced portfolio look like? It includes both stocks and real estate. Offers you the best of both worlds. You don't need to choose between the two. Invest in both. So personally, I aim for my portfolio to have around 60% stocks. This is my total investment portfolio, and around 40% real estate. My stock investments are around 50-50 US and international. It's a mix of large cap, small cap, mid cap stocks. I invest in passive index funds just because it's easy. I don't have to think about it. I invest through a robo-advisor and it's done. I mostly avoid bonds. If you know what you're doing in real estate investments, I think they can replace the role of bonds in your portfolio. That all being said, I am not an investment advisor, so take everything I just said with a grain of salt. This is just my personal strategy. And as for real estate, this is really what we want to talk to you guys about today, is 9 ways to diversify your real estate investments, to create other streams of real estate income beyond rental properties. And that starts really simply with just publicly traded REITs. These are stocks that you can buy and sell on public stock exchanges. They have some unique rules, which we'll go over in a moment. These either own properties directly or they lend money against properties. So these are equity REITs versus debt REITs. Now, there are some upsides to these. Very liquid, right? You can go out and buy and sell them instantly because they trade on public stock exchanges. They tend to have high dividend yields, and we'll talk more about that in just one moment. These are 100% passive. You don't have to manage tenants with these. You don't have to go out and try to spend a bunch of time finding good deals with these. You can just click, set it and forget it, right? You just buy shares and it's done. And it also makes it easy to diversify among commercial buildings, apartment buildings, retail space, industrial buildings, whatever. You can buy shares in these or invest in these. And they come with some downsides. They're very volatile, like everything else that trades on public stock exchanges. And here's the real problem with publicly traded REITs, is that they have a high correlation with stock markets. So you actually don't get much diversification benefit by investing in REITs versus investing in stocks. And they have low growth potential because according to SEC rules in the US, at least 90% of REITs profits each year have to be distributed out to shareholders in the form of dividends. So yes, they have really high dividend yields, at least compared to most stocks. But the downside of that is that leaves the company almost no money to go out and buy new pieces of real estate. And so that really limits the growth potential for these, the share prices. You also, and of course, you have no control over the returns of REITs as well. As opposed to when you own rental properties, you have a lot of control over the returns. So something to keep in mind, bottom line is, if you have $10, you want some exposure to real estate, public REITs offer a way to do that. But you get almost no diversification value from stocks when you buy publicly traded REITs. All right, privately sold REITs. These are typically crowdfunded investments. So private REITs are funds that own real estate or property secured debt, just like publicly traded REITs. But instead of publicly traded REITs, you don't buy shares on public stock exchanges. You buy shares directly from the issuing company. So it's a type of real estate crowdfunding, and we'll give some examples in a second. So they come with their own advantages. One is more flexibility to reinvest their profits. So they can go out and they don't have to give 90% of their profits back to shareholders as dividend yields. Many do, but that's by choice. They have more flexibility to reinvest their profits to buy new properties, buy new buildings, which gives the price per share a much higher room to appreciate in value. They do often have a high dividend yield. Streetwise, for example, and we'll put a link to that in a minute. Streetwise pays between 8 and 9% dividend yields every year. Fundrise, they typically pay between 5 and 7%. Private REITs, a lot less cash required to buy shares in these than to go out and buy your own property, of course. It's an easy way to diversify, just like public REITs. Privately owned REITs, many of them do buy office buildings, or they do own apartment buildings or industrial buildings, or whatever. Trailer parks. They can own all these types of properties that you might not be able to go out and buy on your own. So it's a good way to diversify among your real estate investments. Now, here's the real kicker here. These have a low correlation to stock markets, which is great as far as diversifying and protecting against stock market crashes, which is a big part of this whole conversation, right? Why we should be diversifying. They're also 100% passive, unlike when you own real estate directly. You don't have to do anything. You don't have to screen tenants. don't have to go out and find deals. You just buy shares and someone else takes care of it. And it's easy to automate these investments. You don't have to think about them. You can just set up automated recurring share purchases. Disadvantages, you don't have any control over the returns, just like with publicly traded REITs. And there's also the transparency is not always perfect with these. There is a risk that these companies are going to find ways of like sneaking in higher margins for themselves, hidden fees, hidden charges, even when they tell you that they don't charge any fees, or they tell you, oh, we only charge 1% a year or whatever as a management fee. It's hard to know that, right? I mean, they could be technically overcharging for repairs and maintenance, for example. They send out their own crew and they say, oh, we spent $30,000 on these renovations.
Wow.
When it actually cost them $15,000. I'm not saying that any of them do that. I'm just saying these are possibilities, right? Other disadvantages, these actually do have low liquidity. They're long-term investments for the most part. They don't want you buying and selling them within a few years. Once you buy them, they expect you to typically hold them for at least 5 years. And there are no inherent tax advantages for you, unlike direct real estate ownership. So a couple of good examples. Fundrise, I have some money invested in them myself. They mostly invest in apartment buildings. I also have some money invested in Streetwise, which mostly invests in office space. And Deni will put a couple links in the chat to these companies. So bottom line, it's a great way to diversify your long-term investments. Emphasis on long-term investments, though. Think 5 years.
Is there, you mentioned that you have to be in them a certain amount of time. Is there a penalty?
Yeah, so in many cases, you can sell your shares back to the company in less than 5 years, but there's usually like a step down ladder as far as fees go, it's a discount that they buy them back. So for example, if you sell back your shares to the company in the first year, it might be a 3% discount from what you paid or what the going rate for the shares are in that moment. In the second year, it might be 2% discount from the going rate for share prices. In the third year, it might be a 1% discount that they're buying it back for. And then after that, maybe they will buy it back from you for the actual going share price. But yeah, it's like a prepayment penalty, but for selling back your shares, to put it in like loan terms.
Well, it's that time where we're gonna give you guys
huddle break.
The floor and ask questions. We actually already have some. Carolyn said, these are great slides, great data points. Will we be sharing the slideware?
Yes, I do want to do that. I'm going to try to convert the slide deck to a PDF and make the PDF available.
Actually, I already have that. So yes, we can do that. Forgot I did that.
And the recording, we're assuming that all goes well with the recording, we're going to try to put this up for the next day or two as well.
Cheryl says, any idea on where you can find investors, landlords that need help renting out their place? So I'm assuming you're looking to help manage, I guess.
That's what I would read from that question as well. So it sounds like you're a property manager who's looking to grow your business among landlord clientele?
Yes. As a realtor, I do manage properties for others, but they usually come to me because they know that that's what I do. And I think, in today's world, it's kind of easier with social media, some of the groups that are out there, and it's real important to build a good reputation because it's so easy for people to see that right now. And get into groups where they have investors. Like if you have, I know COVID kind of stopped the meetup groups, but I think it's starting to meet up again. I see some of the brochures coming out and the invitations.
You mean like real estate investing associations?
Yes, yeah, and different groups. You go to them, meet the investors, because you just need one investor who continually invests, and that definitely will build your portfolio.
And check out our Facebook group as well. There's what, 35,000
Yeah.
landlords and real estate investors in there.
Yeah, I can throw. Do I have our link? I have our link.
And you can also check out Bigger Pockets as it's like a social network for real estate investors. So it's a good resource as well for building business.
And any local social media Facebook group. Like if you're in a certain area, you may find somebody in there just by saying, I do this or whatever. You might see.
Yeah, in every significant city, there's a local real estate investing Facebook group. So yeah, it's a good place to find new potential clients as well.
Right. Lomax asked, for real estate, do we have any data on how many landlords were affected negatively and how negatively because of the pandemic-induced rent moratorium? And what sort of breaks did the landlords get? And what is the way forward? We were just talking about this before we came on. I think, well, you know what? It's somewhat back and forth. 1 minute it's lifted, the next minute it's not. 1 minute, let's leave it to the states, and then we all know what's happening there. Because if you have a tenant-friendly state, you have a moratorium going on and on. So who knows when? I know that there have been programs to help some of the landlords who are losing money here, but that money's been held up for. I haven't heard anybody that really got the money. You can apply for the money, and who knows when you're going to get it.
Yeah, I think it was it $46 billion that Congress set aside for rent assistance, somewhere around there. And the last I heard, only 12% of that money had actually been distributed to landlords and tenants. So I don't have any data at the moment for you on that, but hopefully that rent assistance will actually be distributed the way it should be and make landlords whole who got burned by tenants who didn't pay during the pandemic. I think that's just going to, like Deni said, it's going to be an ongoing. We'll have to see how the data unfolds for that.
It literally is. There's something said about it like daily. And we don't know what's going to happen because, they extend it, then they let the extension go down, and then they extend it again. And like Christina was saying, the moratorium's been extended in New York till January. And a lot of your local areas and states are mandating their own rules and regulations. So it's kind of hard to tell, really. Now, it is good to keep in mind that there are certain things that have to come into play for somebody not to have to pay their rent. It's not just because they don't want to, although you get the professional tenants that know how to get around that. But for the most part, if you have somebody that's damaging your property and things like that, that doesn't fall under the moratorium.
All right, I don't want to get too bogged down in moratorium talk.
Okay, I just want to ask this question because it's right up your alley. What is your opinion on a good percentage for cash-on-cash return, not depreciation or principal pay down for a rental?
It's hard to lay out a rule of thumb for that. Every market is different, and every investor has different goals. For me personally, I want to see at least 8% cash-on-cash return for yield, for like annual cash flow yield, not including appreciation, because the stock market going back to the 1920s has an average long-term return of around 10%. So I want to at least be around that for my real estate investments as well. So yeah, for me personally, I look for a floor of around 8% cash-on-cash return for cash flow only, not including appreciation. The short answer to that question.
Okay, sorry, Brian, go ahead.
All right, and by the way, we're going to do another huddle in a couple minutes for more questions, and then we'll do another Q&A at the end. So, keep the questions coming. We will address them. All right, so number 3 on the list, real estate debt crowdfunding, which is different from the private REITs that we just talked about. So these are typically hard money lenders they're issuing short-term purchase rehab loans for flippers or for rental investors following the BRRRR method, where they buy a fixer-upper, renovate it, and then refinance it to keep with a long-term tenant. So these hard money loans, these are short-term loans, typically repaid within 6 to 18 months, at which time the property is either flipped and sold or refinanced to keep as a long-term rental. Now, some of these hard money lenders do raise funds through crowdfunding. And these come with some great advantages for you as an investor. First of all, it's really easy to diversify. You can often pick and choose which loans you want to put money towards, and in some cases put as little as $10 towards each loan, so you don't have that much exposure to each loan. And again, low cash required there as well, right? Like $10 per investment. That's who doesn't have $10, right? I mean, and these also, again, low correlation to the stock market, which means you get some good diversification value, away from stocks. Other advantages, you can pick and choose specific loans that you like, based on the LTV, based on the interest rate, based on the borrower's experience. These are 100% passive. Again, you don't have to go out and screen tenants or sign leases or deal with maintenance headaches or any of that stuff. It's also really easy to automate these investments, especially. So we'll give an example in a second of one that I invest in and I personally like, called Ground Floor. You can set up automated recurring investments through them. And these, unlike private REITs, these are short-term investments because these are short-term loans. Again, most of these loans are 6 months, 12 months, maybe 18 months at the longest. But these are short-term loans, which is unusual in the world of or short-term investments, which is unusual in the world of real estate investments, which is typically considered a long-term asset. Now, there's disadvantages, of course, too. There's low liquidity in these. Once you invest money into one of these loans, you can't get it back until the loan is repaid. So your money does get locked up for those 6 months, 12 months, whatever. There are no inherent tax advantages in this for you. So my favorite example of this is Ground Floor. Again, I have some of my own money invested in loans in Ground Floor. I really like them. We'll put a link in the comments to where you can check them out if you're interested. Again, you can pick and choose individual loans with them if you like. Their loans pay, I think they pay between 6.5% and 14% interest, depending on the risk level of the loan. Like, they grade the loans by risk. The lower the risk, the lower the interest rate that they pay, of course. Or you can lend them money directly at 7%. That's a lower risk thing because you're lending money directly to lending or to Ground Floor, but they only pay a maximum of 7%. So, but yeah, I really like Ground Floor. It's a great way to diversify. All right, number 4. You can always buy rental properties in other markets than where you live. Now, I know we technically said that this webinar is about going beyond rents, but this is really more about diversifying your real estate income. So if you have rental properties in the city where you live, a good way to diversify is to buy rental properties elsewhere in the country. So, most people, it never even occurs to them to buy outside of their home city. But it's easier than ever to do that. So here, Deni, I've been talking a lot. You take over. Talk to us about long distance rentals.
Well, I mean, it's a great option, especially for those that live in more expensive areas to even invest in. New York is a tough one. Or, as we talked about recently, some of the more tenant friendly areas. It's a good way to get out of those areas and invest in some areas that are not only less expensive, but more landlord friendly as far as law perspectives. So that is, it raises your cash return. We were just talking to, I forget who it was, but we were talking to somebody who was investing in San Francisco.
Yeah, so we have a real estate or course, an investing course called Fire from Real Estate, all about how to replace your 9-to-5 income with rental income and real estate investment income. And we include a strategy session with that course. Anyway, so we were doing a strategy session with a student who lives in San Francisco, which is possibly the worst market to invest in rental properties in.
So expensive.
Both for cap rates and for the regulatory environment. So anyway, we were encouraging her to look at other markets. Anyway, Deni, I didn't mean to steal your thunder there.
I mean, there's good and bad with that as well, Brian. I mean, the bad is that it's, you know, a little far away, but there are resources that can help you, like Allie Boone, right?
Mm-hmm. Yes,
so
she's great.
Sometimes long distance works out better, especially again if you're in those expensive areas or tenant friendly areas. An example is Roofstock, and I will put the link in the chat in a few seconds. But Roofstock kind of does everything for you. They do an inspection report, you have photos, the virtual tour, so you virtually can see it, an appraisal, you'll have the neighborhood data, school qualities, all of that stuff. So it's not like you have to go out there and do the investigation and everything. They kind of do it for you. And they give you a 30-day money back guarantee on property and a 45-day rent guarantee. So you get 2 guarantees on that. So, I mean, where else do you get guarantees, right?
Yeah, with real estate investments.
Serious.
Yeah, I mean, and Roofstock is really specifically built for long distance rental investors. The most recent stat that I heard was that it was something like 62% of the purchases on Roofstock are from investors who live at least 1,000 miles away from the property that they bought. So most of the buying and selling on Roofstock is among long distance real estate investors.
Does Roofstock
and by the way,
they manage their properties?
No, but they don't manage it directly, but they have a network of local certified
companies.
property managers that they certify themselves. So you can feel pretty confident and comfortable with their certified property managers. And we do a free video course on rental investing, which you should check out as well. And that's on you can find it on the menu bar on our website. It's quick and snappy and easy, like 10-minute videos. I think it's 8 videos and they're each like 10 minutes long. So Deni, what are some of the advantages of long distance rentals? I guess we already went through some of these.
Yeah.
you already went through this. Yeah, so better markets, higher cap rates, lower prices, more landlord friendly laws, good way to diversify within your real estate portfolio. And you don't have to worry about renovations if you buy a turnkey property that already has a tenant in it or is move-in ready. And unlike some of the other examples that we've given, as a landlord, you do have a lot of control over your own returns. And not only that, but you can predict the returns by running the cash flow numbers before you buy. And of course, you get all the tax advantages that come with direct ownership of real estate.
And if you have to travel to the property, you might be able to write off the travel. If it's in a nice place.
That's right. What are some of the disadvantages of long distance rentals?
Well, you're still dealing with tenants, so it's not 100% passive. You still have to do your tenant screening and everything, unless you get a property manager, but you have to make sure and vet them. Requires
manage the manager.
Yes, serious. Requires trusted local support personnel. So you're going to need contractors, maintenance, people that you've built some kind of rapport with. And it is harder to find great deals or fixer-uppers, especially right now where real estate market is a little crazy.
Yeah, absolutely.
You also need cash, so you're going to need more cash. It has low liquidity, so it's a long-term investment and very difficult to automate long-distance rentals, although that's becoming easier and easier as time goes on and technology gets better and better.
With landlord software like SparkRental.
Oh, yeah.
Sorry, I had to lob it in there.
Bottom line, though, it is a great way. It's another way to diversify your rental portfolio, and it has, everything has its pros and cons. So this does too. But for people that again are in those, hard to invest in areas, this is a good option.
Absolutely. So a fifth option here, we recently launched a pilot program that we call co-investing, where we buy a rental property, and you can actually join us as a junior partner in owning this property with us. So, we sell shares of the LLC that owns the property in 1% increments. So your name goes on the LLC as a partner with us. So you directly own the property alongside us. Now, this is something that we just did our first property with a couple months ago. So it's a pilot program. It's not widely available. For that first deal, I think we only even invited like the dozen or so people that had specifically asked to be on the waiting list. We are hoping to open up the next deal a little bit to a few more people, because this first deal has been very successful and it's been a lot of fun. So if you are interested in getting on the wait list for our next co-investing deal, just shoot us an email and let us know, and we'll put you on the wait list. But the whole idea is that you learn while you earn, or earn while you learn, or whatever. You get to see behind the scenes of everything, the renovation, listing the property for rent, and marketing it, and tenant screening, and leasing, and all that kind of stuff, while being a direct owner of the property alongside us. So, it's 100% passive, or mostly passive, to the extent that you want it to be. We do weekly phone calls, at least during the renovation period, to keep you posted on what we're doing, how the renovations are coming, any property management related stuff that we're doing. So you get an education while you earn money on a real estate investment. Does not require much cash, because the investments are in 1% increments of the property. You do get full tax advantages as a direct investor, as a true partner with us. Some disadvantages: it's low liquidity. This is a long-term investment, like any real estate investment. So it's not quick and easy to unload your investment if you suddenly need the cash. Other big disadvantages: it's not readily available. We've only done one of these so far. We're hoping to do another one over the next month or two, but it is dependent on us actually putting these together and finding deals. So it's not like something you can just go out and buy at any time, like with those real estate crowdfunding investments or public Reits or whatever. But this is something that we have started offering. It's been fun for us. It's been a good way to kind of showcase the exact behind the scenes, and here's how to invest in real estate. Here are some pitfalls to avoid. And it's an easy way to diversify your real estate investments. But again, only when it's available, which is not necessarily.
a lot of people have been asking, so it is a good and popular idea. So.
Yeah, and again, if you're interested in being added to the wait list for the next property, just shoot us an email, support@sparkrental.com, and we'll let you know when we line up the next property. All right, Deni, talk to us about number 6, investing in land.
Well, sorry, Christina Colin said, Brian, get to work, get more deals.
I know, I gotta hop to here.
All right, land investing. Well, land perhaps is not sexy and not competitive to invest in. It's certainly not expensive. And the best part to me is it's not regulated like housing is. So you don't have to evict an ant running around your land pile. Yes, you can.
No, please. I keep going.
Well, no, I was just saying we now are getting involved in this, and it's exciting to me. It's new for me, but I'm learning so much, and it's really exciting. So you flip parcels, and you actually can have like 200 to 300% on your returns. You buy and you hold, and then it's not like so outrageously expensive that your money is tied in anything. So you can buy and hold, and then speculation that specific land will skyrocket in value, and land does go up. That's,
Yeah. So you can flip, somewhat quickly if you want, or you can, buy and hold these parcels for the long term if you think that the land value is going to, skyrocket up in value. So what are some of the advantages here, Deni?
Like I had said before, low cash is required. No renovations to land or repairs. So you don't have to deal with maintenance men, contractors, painters, and the like, and no tenants. So I hate to say it like that, but it's no calls about, this is broken, no worried if you're going to get your rent or not. None of that, so that stress is out of this.
Yeah, and honestly, two of the hardest parts of being a landlord are managing contractors and managing tenants. With land, you don't have to deal with either one, so it's really easy. Yeah, it's much
like
easier.
Christina just said she bought some vacant land about a month ago and is selling it right now for small profit. She put it on the market and got an offer in a day. So yeah, land can be very good. Advantages is a short-term investment, enormous potential returns, and potential for passive income.
Oh yeah, so the way passive income works with land investing is a lot of investors, they'll flip the land and they'll offer seller financing on the they'll offer a private note on the land. It's actually technically not seller financing. It's more of like an installment contract because you don't actually deliver legal title to the land parcel until the person has finished paying you off in full. So you don't have to go through the whole foreclosure. At least that's how we approach it. So you don't have to go through the foreclosure process. It's just the eviction process, which is negligible for vacant land where no one's living.
Right.
So you can get that ongoing passive income in the form of seller financed notes, private notes.
And there's little to no regulation. It's instant, simple. You just evict them if they're not paying on their monthly installments. Not intuitive. It forces you to get you don't have to really like get out there, and there is some education, but yeah.
Well, let me jump in there and say that. So one of the problems with rental properties is that they feel intuitive to investors. People say, "Oh, I've been around real estate my whole life. I've been living in it my whole life. I know how rents work. I've been a tenant before. I've been a homeowner before. I know how all this stuff works." And so that people get cocky, like new investors get cocky about it, thinking that they know about real estate investing just because they've been a homeowner. But that's kind of like saying that you know how to be a professional NFL player just because you watch the NFL on Sundays or because you played in high school. Land investing, I actually think this is a big advantage, that it's not intuitive. So that actually forces you to go out and get a proper education in land investing and not just assume that you know everything you need to know. Because you are forced to go out and learn the ropes of something that's unfamiliar to you, you'll make fewer avoidable mistakes.
They're less expensive mistakes, because I have made mistakes in purchasing properties, and we're talking a lot bigger than if you make a mistake purchasing a piece of land.
I've lost hundreds of thousands of dollars.
Well, I didn't want to say the amount.
I've lost a massive amount of money in rental properties. With land, you can buy parcels of land for $100, $500. So
Crazy.
If you make a mistake, it's a couple $100 mistake. That's like going to a nice restaurant and not being happy with your meal that you chose and being, oh well. Like, I mean, it's a $100 mistake.
And I have to tell you, I was a bit skeptical when we first were, talking about this and we were learning about it. And my mind is a bit blown because I don't know, it's crazy. It's real.
Yeah. So, I mean, Deni and I have definitely been bullish on land investing recently. We've been land investing ourselves for not that long, maybe 6 months now. But it's been great. It's been a lot of fun. It does, like everything else on this list, it comes with some disadvantages. it feels more like a business than an investment. And I'm not even sure how to put that in a more eloquent way. It doesn't, in many ways it's intangible because you never actually see the land that you're buying and selling. So in some ways it kind of feels like pushing paper. It's not passive at first. There's a lot of business systems you kind of need to put into place and understand in the beginning, and you can automate those so that you're only putting in a couple hours of work a week or a month in your land investing business. But that automation takes time and it takes work. So, this is not nearly as passive as, say, going out and buying shares in a private REIT or, real estate crowdfunding debt or co-investing on a property with us. Like, it's not nearly as passive as that. This is more actually building a business. But if you're interested in building a side hustle business that's involved in real estate, land investing is a good one. You can make some really good returns in it.
Right.
So, as for where to learn land investing, our friend Seth Williams is one of 2 premier land educators in the country. I mean, in fact, he's one of only 2 really top level land educators that I know of in the country. And then the other one being Mark Podolsky, who we did a webinar with a couple months ago, which some of you guys were here for. But yeah, check out Seth Williams' course on land investing if you're interested. We'll put a link in the comments. But he really is, he's top-notch land investing educator in the country, has a good podcast on it as well. But he knows his stuff.
He has a real heart for educating. I love the way, just his attitude on stuff.
Yeah, I love Seth in general. He's a very good guy, honest guy, very easy to work with, and knows his stuff. So, bottom line, fantastic way to earn high returns, diversify your investments. But again, you have to be willing to learn a new business, which not everyone has the time for or the inclination for.
Right.
So, all right, let's have a huddle and look at some questions.
All right. Let me go back here. Okay. Is the co-investing pilot for acquiring single-family units or for multi-units? I think we're doing single now, right?
Well,
no,
so what's that, Deni?
Sorry, go ahead.
The first property we did was a single-family property. Doesn't mean that we will never buy multifamily properties. It just depends on what kind of properties, what kind of deals we find available. The first one we did was a pretty affordable property, and that was by design. We wanted to make the first one a pretty low entry cost property because it's experimental, right? I mean, it was a pilot program. We wanted to make sure that the whole thing went smoothly and worked. But that doesn't mean that we won't scale it up to multifamily properties as well.
What is the best type of land to buy? And this is from Beverly.
Well, so here's the thing. Different land comes with different uses and different appeals. So, for example, you go out to like Colorado or Arizona, a lot of people will buy land for recreational use. So they might buy land that's a couple hours away from where they live with the intention of going and like camping on it, maybe taking their RV out there, fishing, hiking, that kind of thing, or ATVing. Some of the properties that we've bought in Florida, they're more building lots where the idea is that someone will buy them to build their dream home on, as opposed to buying the land for recreational use. And then there's everything in between. Some people buy land for like bird watching.
Right.
I mean, some people buy land for like, turning it into farmland, so there's all kinds of different uses for land. And as you take a course like Seth's course, he'll walk you through some of these different models of buying land and help you pick one that you like and you're comfortable with. But there are really endless models for how to choose land to invest in.
We have a question from Christopher. Between land investing and lease option, creative financing, which active business would be easier to get in and establish? I think they both have, there are barriers to entry and some eases to them as well.
Yeah, I mean, obviously land is a lot cheaper, or at least has a much lower floor price, so you can get into land investing with less money. And if you don't have much money, that's really important to you. Buying properties to like semi-flip through lease options. I mean, it's a tried and true business model. There's nothing wrong with it. You need to have the money for a down payment. You need to be able to settle on the property, and you need to go through the motions of screening tenants and potentially renovating the property if it needs it, managing tenants until the time when they execute on their option to buy the property. So yeah, I mean, I guess the simple answer to that question is, how much money are you willing to invest, or do you have to invest? Yeah, there's no right or wrong answer there. These are all just multiple ways to invest in real estate and create some income streams through real estate.
And then L. Jackson asks if there are loans available for a land purchase. Land?
There are. They tend to be lower LTV if you go through a bank, like very low LTV. That being said, a lot of people will offer seller financing on land, so you can finance them that way. So yes, there is financing available. Your best bet for it is usually seller financing rather than going through a bank, and that's something you just have to negotiate with the seller. All right, so Deni, should we save the rest of the questions for the Q&A at the end? Because we're getting close here. We're getting close to the end.
Yes, okay.
All right, Deni, tell us about mobile home parks.
Well, I'll be totally honest. I don't know a whole lot. It doesn't seem very sexy, but it does. That should sound familiar. It should sound like profits. Case study from Mr. 1500, and I'm going to put a link in for him, 1500days.com. He bought a trailer park in 2017 for $170,000. Sold it in 2021 for over $319,000. So you can do the math there. Case study again from.
Well, yeah. So the math is, he more than doubled his money.
Right.
In 4 years. So great investment, right?
But that has, I was just going to say, the advantages are there's not as much competition than your traditional renters, and there's a potential, as we just saw, for higher rents. But, and it's also lower cost per unit. Often tenant handles repairs and maintenance, and there's a lower tenant turnover rate, so people tend to stay in them longer. Disadvantages are there is challenges in enforcing the maintenance with tenants. It's niche marketing, so it's a whole different way to try and fill vacancies, and financing
can be harder to fill vacancies in mobile home parks. Not necessarily, but it can be.
Yeah, I think that too depends on price and market and whatnot, and financing can be tricky.
Yeah, it's a lot harder to get a loan for a mobile home park than it is for a rental property.
Right.
Doesn't mean you can't do it, but you're probably looking at a lower LTV, like a lower percentage of the purchase price, so more of your own money. And you're probably looking at a higher interest rate as well.
So if you want to learn more, Rachel Hernandez, who's the mobile home girl, she's going to be on our podcast November 16th at 2 o'clock, which is a Tuesday. We do them every Tuesday.
2 o'clock
I'm going to put
Eastern.
a link.
11 a.m.
Eastern. I
Pacific.
always forget you know.
You forget that not everyone is on your time zone?
Yes, I do. There is a link to her case study, which is very interesting.
No, that's the 1500 days case study that we put the link to.
Great. Oh, sorry guys. Yeah, it's late. It's late for me, so I'm not really with it. But I also am going to give you the link to our Facebook page, because that's the page you want to visit on November 16th at 2:00 Eastern, and you can see her be interviewed.
All right, so number 8, we're getting down to the wire here. So number 8 is invest in international real estate, which most Americans have never considered, which you can read as a competitive advantage. You know, kind of like with the land investing, not that many people do it, which can be a great advantage to the people who do. So you have 3 real options for investing in international real estate. One is you can buy publicly traded REITs that own real estate internationally. So that's really easy. Anyone can do it. You know, that's something you can do in 30 seconds after leaving this webinar if you wanted to. You know, a more difficult, you know, a moderate difficulty is you can invest in international crowdfunded real estate, which is something that I have started trying to do recently. I will admit that it's been trickier than I thought it was going to be. You know, there was a lot of banking regulations involved. And you have to prove your identity and, you know, jump through some hoops. And it's not necessarily easy for American citizens to do. And then the most difficult way of investing in international real estate is to go out and actually buy properties directly overseas. So a couple weeks ago, we had Becky Nova on our podcast, and she and her husband own property in the Dominican Republic, where her husband is from. Now it helps. It helps them that he is from there. But you can go out and buy properties overseas. You just need some good local partners, just like buying properties out of town in the U.S. Financing is more difficult when you buy properties overseas. Again, doesn't mean you can't do it, but it is a lot more difficult. So here are a couple examples of European real estate crowdfunding websites. I've been in the process of creating accounts with these sites. I don't have any money tied up in them yet, so I can't personally speak to the experience of investing in these, but these are a couple that I've vetted. I'm in the process of trying to get accounts set up with, if you just want some examples. Oh yeah, so if you are interested in hearing Becky talk about her experience with their property in the DR, you can check out our podcast episode. We've had her on twice, episodes 14 and 56 in our Live Off Rents podcast. You know, a couple advantages here is there are the potential for high returns. Like there's a Brazilian real estate crowdfunding company that I've been trying to set up an account with. It's been a little tricky, but a lot of their investments, they offer like 20%, 21%, 22% returns annually on some of these properties, because they are relatively new platforms, especially in the developing world. There isn't the same amount it's not as established in Brazil, for example, and there's just less capital running around in general in Brazil. So there's less capital chasing all of these investments. So to attract capital, these platforms have to offer good returns. So there is a potential here for very high returns. And of course, this really helps you diversify your real estate investments, right? And you get all the other inherent advantages that come with direct ownership of rental properties as well, at least if you directly own properties. They come with a lot of headaches or a lot of disadvantages. Legal headaches in being a foreign buyer of real estate in a different country, banking and borrowing headaches, contractor headaches, especially if there's a language barrier, and you really have to outsource the property management. It's really hard to self-manage properties in another country yourself. So, this is definitely a more advanced form of real estate investing, other than just buying shares in a publicly traded REIT that owns international real estate. So we only recommend doing this after you've looked at some of these other options that we've talked about before, because it's more advanced. There's more headaches. But we did want to include that as an option out there to really help you diversify. And last but not least, number 9, lend private notes to other real estate investors. So a note is a legal document. It's what you sign. It's the legal document that you sign when someone takes out a loan. So if you own your own home and you borrowed a mortgage, when you bought that home, you signed a note with the lender. And a private note, of course, is a private loan between two parties. So, for example, if you were to lend me money for me to go out and buy a property, we would sign a private note where I would promise to pay you back at a certain percentage interest over a certain number of years. So, for example, you guys might remember the case study that we did with the Thompsons, Ashley and Kevin Thompson. They retired at 30 and 36, by the way. So they own, I don't know, something like 15 rental properties, maybe even more than that. And some of them they own with a mortgage. Some of them they own free and clear. And some of them they have financed with private notes. I mean, I actually have some money lent to them myself in the form of a private note because I know them and I trust them. I know that they know what they're doing. They're knowledgeable and experienced real estate investors who don't take undue risks. So these are 100% passive, which is awesome. Unlike some of these on this list where there's a lot of work involved. You can negotiate your own loan terms. Whatever interest rate you want, you can negotiate. If you want to charge points up front, you can negotiate that. The lending term, the loan term, is also negotiable. How long you want the repayment term to be, and it has a potential for strong returns. I mean, I've lent private notes before at 12% interest, and gotten every cent of my money. So disadvantages, it can be difficult to enforce. So in order to actually have it secured by a lien against the property, you have to actually file a lien in that court against the property. And then if the borrower defaults, you'd have to go through the whole process of foreclosing to force the sale of the property and get your money back. So it can be difficult to enforce. So it's really dependent on trust, right? You really have to know and trust the people that you're lending money to. Because if you don't and they default on you, it's going to be hard to enforce that loan. And this is something that it really can't be automated. These investments can't be automated. Now, that being said, you really should only be lending money to people you know and trust. So there's not really a need for automation. You go out and you find investors that you like, that you trust, you know that they know what they're doing, and you lend them money. So there's not a whole lot of work involved from that standpoint. But again, it's all based on trust, experience. You should only be lending private notes to real estate investors that you like, you trust with your money, and that you are confident that they know what they're doing. All right, next steps. This is your homework. So pick one of these real estate strategies and do a deep dive on the research on it. You can start with articles, podcasts, some of the courses that we linked to. If you want further reading recommendations that are specific to your goals, send us an email. Email us at support@sparkrental.com, and we'll send you back a couple specific recommendations based on what you're looking for. But a lot of this stuff is free. Articles are of course free. Podcast episodes are free. There are free courses. There are paid courses. There are webinars, of course. So do a deep dive into one of these that really speaks to you. And if you don't like what you see with that in your research, pick a different one and research that. And keep going until you find one that you really like, that you're comfortable with, and then invest some of your own money in it. And if you're looking for a really inexpensive way to start, try ground floor, because you can invest with $10 in ground floor. And like we said earlier, everybody's got an extra $10.
Just don't go to Starbucks that day.
Yeah, exactly. So that's a really easy starting place if you're just looking to kind of dip your toe in the water with a little bit of, just a little bit of money. All right, so a quick recap of what we talked about today. We talked about the different roles that stocks and real estate serve in your asset portfolio and why you should invest in both, how they complement each other with their strengths and weaknesses. We talked about how to automate your stock investments with a robo-advisor, and that's actually really important, that your stock investments be on autopilot so that you have the time to invest in real estate, which does take more time. And then we went through 9 ways to diversify your real estate investments. So publicly traded REITs. Number 2 is private REITs, crowdfunded REITs. Number 3 was crowdfunded debt, real estate crowdfunded debt. Number 4, you can invest in long distance rental properties, usually turnkey rental properties. You can partner with us in our co-investing program. Number 6 is investing in land. Number 7, you can buy mobile home parks. Number 8, international real estate investing, whether that's a publicly traded REIT, crowdfunding, or direct ownership. And then last but not least, number 9, you can lend private notes to other real estate investors. So we went through a lot of links in this, a lot of information, a lot of case studies and examples. So we are going to try to email out this slide deck with all the links included in it, if you like. And of course, all those links are in the comments as well. So this is where a sales pitch would normally be located in a webinar. We're not doing that today, as we talked about earlier. So sorry to leave you hanging on the sales pitch.
We'll give you a discount if you.
Right. So you can connect with us through our website, SparkRental.com. You can email us at support@SparkRental.com. You can connect with us through our Facebook page, Facebook.com/SparkRental. All pretty easy stuff. So, all right, Q&A. Deni, what do we have?
We have Eric asking, would you know if there are collection issues with mobile home park rentals, considering the social strata of most residents?
You can, you can evict non-paying tenants, of course, and enforce your lease agreements that way. I think it really depends on the location, just like with detached single-family rentals or townhouse rentals or anything else. There are some highly coveted mobile home parks in this country where there's a lot of competition to live there, and people are very good about paying. And then there are some really low down, down on their luck kind of mobile home parks as well, where you might have a lot of those collection issues. So I think it's just market by market. It's location by location. It just depends on what kind of area and what kind of park you want to invest in.
Right. And, if it is in one of those areas, you're going to still have to do your due diligence and make sure who you're renting to.
Mm-hmm.
What are your thoughts on tax liens, since it was not mentioned today?
I've never bought properties through tax liens or bought liens again. I've never bought tax liens either, or foreclosed on them. So I don't have a lot of direct experience with it. Deni, do you?
No, not at all.
So here's what I do know is that the rules can get a little complex. So you really need to know what you're doing. Like many of the investment strategies that we talked about today, you really need to go out and either take a course or get really serious about the education with it, because with tax liens in particular, there are a lot of legal minutia, for lack of a better way of putting that. Like you really have to dot every I and cross every T and make sure that you are going through the right legal procedures, both when you buy the tax lien, when you foreclose on the tax lien, when you retake possession of the property. There's a whole legal process involved, or really a series of legal processes involved. So get a proper education before you do it. Yeah.
And Timothy asks, where would you recommend to go in seeking trustworthy and fair terms for a private lender in funding real estate investments?
Well, I'm glad you asked. We have an entire page on our website that is dedicated specifically to lenders who work with real estate investors.
I will put that right in the...
Yeah, so if you go to our website, SparkRental, it's the loans tab on our menu bar. And we have a whole bunch of charts on there, like tables that compare their loan terms, interest rates, LTV, prepayment penalties, which states they lend in. So a couple of Deni's of my favorites are Lending Home and Visio. But we've worked with a bunch of these. Patch of Land is good. Lend-In-See is good. So check out that page because there's a wealth of information comparing all of these different lenders and their loan terms.
Right. I don't know the answer to this, but I'm going to ask it. Eric, is it true that most cities no longer allow new mobile home park developments?
I don't know the answer to that either. What I would hazard to say to that is maybe large cities, like major cities, probably don't allow them, but most of the land area of the U.S. does not fall inside the borders of a major city. So smaller towns, smaller cities, it's probably still allow you to create mobile home parks. And of course, many of these are rural as well. So.
Right, and I think I've seen like new parks going up, like the further country you go. So, I think that's it. We have some comments. Thank you for the webinar. You both seem sincere and looking to help. I think that's a big passion of both of us.
It is. Education is a huge passion for both Deni and myself. It's why we've published, I don't know, 200 and some articles on our blog at least. It's why we do a weekly interactive podcast where you can come ask us questions in real time. It's why we do these webinars. Education is huge for us. Like I said a few minutes ago, I've lost hundreds of thousands of dollars in rental properties over the years. Most of those losses were because of mistakes I made when I first started out because I didn't have the education that I needed. So it's a huge, it's a huge passion for Deni and myself. We don't want you guys to make the same mistakes that we made when we were in our first few years of investing in real estate.
Absolutely. And Chris said perhaps a tri-state area meetup of Philly-based meetup at some point. That would be so cool. Paris said that would be cool, Chris. He agrees. We could start our own little real estate investment group.
There you go.
I think that's it. We have been on for quite a while, so.
Well, thank you guys for joining us. This has been a lot of fun for us. Hopefully it was fun and informative for you guys as well. And please reach out anytime. Support at SparkRental.com. You can reach Deni and myself through our Facebook page. Don't be shy. Don't be a stranger. We are very responsive to everyone who reaches out to us. So yeah, please don't hesitate to reach out anytime.
All right. Have a great day, guys. Almost the weekend. Woohoo.
All right. We will see you guys on Tuesday at our next live podcast broadcast.
Good day.